Welcome to the Money Over 50 podcast, brought to you by Michael Hogue and Ali Hogue from Money Over 50 Financial Advisors. This information is general in nature and does not take into account your objectives, financial situation, or needs. Therefore, you should consider whether the information is appropriate for you and your personal circumstances. If you require personal advice, please contact Money Over 50 Financial Advisors. Here are your hosts, Michael and Ali Hogue.
Welcome to the Money Over 50 podcast with Ali and Michael.
We're back. Been a while, bit of a hiatus, however you say it. I forget the term, but
you say hiatus, I say hiatus. So
we've had a bit of a break. It's been a long time, and we've had a lot of listeners and clients basically begging for us to come back in, which is great. So people are listening, people are intrigued, people are learning things. It's been we had a bit of a tough time today trying to get into the booth. Nothing was working. Things were booked out, but we're here.
Yes, good. And look, it's been a while for me. I went back and checked. I think it was April 2023, the last podcast that I did. We put it down for a little while. We got really, really busy. And it's one of those things that time just flies. Here we are, early February 2024. And back in the booth for the first time for a while for me. Ali, you've been doing some podcasts on your own, which has been great.
It's those solo ones are a bit harder though. There's no flow. No. You know, I'm waiting for someone to ask me a question, but I realise now I've got to ask myself the question. It doesn't feel natural, so a conversation works a lot better, that's for sure. Yeah,
absolutely. I believe so as well. So it's our first podcast together, so it's good. Exciting.
Is. Massive milestone. Massive milestone. See how it goes.
We have a listener question that we're going to start off with. So, there's been heaps of listener questions come through to the Money Over 50 podcast email. Bear with us because we're just going back through those now. Some of those came in 2023. We will cycle back through them, and it's really good to get those listener questions. We will cycle back through them and answer those questions for you guys, but just bear with us.
Yeah, so the one that we'll start with is from Renee and Paul. So I got in touch with them yesterday actually and answered this question, but we thought it might be a good opportunity to explain it to everyone else because we do realise that, you know, we know what we know, but of course we work around this industry day in, day out. So we got to take the time to explain these concepts anyway. So I'll read off the message. Good morning. I've been listening to your Money Over 50 podcast and have received a wealth of information. Great listening. Thank you. I do have a question though that I'm hopeful you could clear up for me. Your podcast, episode 313, is talking about the carry forward provisions for concessional contributions. I understand the concept, however, I was then confused with the example at the end. You make mention of a high income earner who contributed $50,000 and received back $20,000 by claiming it as a tax deduction. How is this example relevant to the concessional cap? I thought after-tax contributions were non-concessional. Is it the tax return component of $20,000 that counts towards the concessional cap? And what happens when that $20,000 is contributed back into the fund like you suggest? So reading in between the lines, I guess the main question is, or the main thoughts there is understanding different types of contributions. That's what you sort of gather from that?
Yeah, look, absolutely. Look, it is confusing, and I know where the confusion comes from. Most people have in their mind that concessional contributions are salary sacrifice contributions or employer contributions.
Now, at one stage, that used to be the only way, wasn't it?
It was for wages and salary earners. It was, So for business owners, they could do it the lump sum way, but at one stage many years ago, that was the only way. So people have, I guess, conditioned themselves to think of salary sacrifice employer contributions as concessional contributions.
Yeah.
And they've thought of lump sum contributions as non-concessional contributions. Now, I can understand that because
I mean, they're right at the very start.
They're right at the start. Yeah.
It is does get confusing, but I guess the main thought is that they're right. When you do make contributions into superannuation using your after-tax money, so personal contributions, they are classified as non-concessional, and that happens at the very beginning. Now, the tricky part, I guess, here where the confusion can pop in is what you can do with that contribution. So basically, what we sort of described there is we describe claiming a tax deduction on that amount. So a way you can do that, so there's a form called a notice of intent to vary.
To claim a tax deduction.
To claim a tax deduction. There's a vary one as well.
Notice of intent to claim a tax deduction form, yeah.
So there's a form you can do. A lot of super funds make it easy for you anyway. But basically what that essentially does is, using those personal contributions, you're able to claim an amount of that. You can do the full amount or a portion of that. And what it does is transfers that or changes the properties of that contribution into concessional contributions. So rather than, I guess, with salary sacrifice, what happens there is you're paying with before tax money at the very start. So you receive that tax saving throughout your payroll. Now, when you claim a tax deduction, you change the non-concessional contribution to concessionals. And essentially what that does, come your tax return time, it will reduce your taxable income down by the amount you've claimed the deduction on. Now, I know I'm saying deduction and concessionals so many times, so bear with me here. But essentially what happens then is, say we've made a $50,000 personal contribution, so non-concessional. We decide to claim the full amount as a tax deduction. If your taxable income was $100,000 for that year, essentially you're bringing it down by $50,000. So your taxable income will be about that $50,000 mark. And that tax savings is not something that you see throughout your income over the year, but you will see that with an increase in your tax return. Is that right?
Correct? Yeah. Right? So let's go through, because it's a hard concept to explain over audio.
I've actually got a thought on this too. So I was thinking. So when I explained this to them, I was typing it out, and I realised typing it might not get the picture through.
Yeah.
So what I will do at the end of this is attach a short video anyway in the description, and just explain the concept visually as well.
Yeah, that's a good idea, Ali. So I guess in this situation, so superannuation funds will have a way of contributing, and they have BPay numbers now, and that they will call that a personal contribution. Now, personal contributions start out life. Think of them starting out life as a non-concessional contribution. So in this example, if this person would have put $50,000 in as a lump sum, Renee, you're correct. That starts out life as a non-concessional contribution. $50,000 leaves this person's bank account. It goes into their superannuation fund, and it's immediately assumed to be a non-concessional contribution. Therefore, no super contributions tax is deducted on that. As Ali was displaying before, the way that you turn that into a concessional contribution, which is then a personal tax deduction to this person, is that you lodge what is known as a notice of intent to claim a tax deduction form. Now, superannuation funds, each superannuation fund has that form, has an official form called a notice of intent to claim a tax deduction. It is an ATO form. However, superannuation funds will put their own logos on that. So in this example, a person has, as Ali said, $100,000 taxable income. In a basic example, they contribute $50,000 as a lump sum. It starts out life as a non-concessional contribution. Assuming that they have the cap space, the concessional contribution cap space, so they would need to be tapping into what's known as carry forward concessional contributions. They could potentially allocate that entire $50,000 as a concessional contribution by completing the notice of intent to claim a tax deduction form. What will happen then is the superannuation fund will deduct 15% tax from the amount nominated on the notice of intent to claim a tax deduction form.
Yeah, that's correct.
So in this case, they would deduct $7,500 in super contributions tax. That previously non-concessional contribution, it started out life as that, has now become a concessional contribution, and it is reclassified internally in the superannuation fund and reported back to the ATO now as a concessional contribution, along with the 15% tax deducted. The super fund then issues a receipt for that. That person takes that $50,000 receipt to their accountant at the end of the year, and that $50,000 receipt is then used to reduce that person's taxable income. So in this example, that person's taxable income, which was previously $100,000, has reduced by $50,000 down to a taxable income of $50,000.
Yeah,
so there is tax savings on that.
There is. So
they are in a tax bracket that is between 34. Well, it's a solid 34.5% tax bracket. Any income that they earn over $45,000, what they would be doing is claiming that. In effect, they would be reducing their tax, as in they'll get a tax return of 34.5%.
Yep.
Of $50,000,
yep.
Which by my calculations is 17.
Yeah, 17.5%. So that's sort of money in the hand. That's your income tax savings. Now, bear in mind, there is still that 15% tax that is paid inside the super fund when you make concessional contributions. So overall, you'd be getting a overall tax saving of $10,000. But the handy thing of having the $17,500 in the hand is that it's basically a forced saving over time, and you can use that. That can be another tool for future years to potentially get that money back into super, and then again get another tax saving as well.
If we go through this, it is I call this a tax arbitrage.
Yeah.
So you're paying 15% when you reclassify it as a concessional contribution on the way in. So that's you're losing 15% internally in your super fund from that $50,000. However, this person on $100,000 income is firmly in the 34.5% tax bracket. So they're claiming 34.5% as a tax return. They're paying 15% out of one hand. They're claiming 34.5% in one hand. It's a significant rate of return. It's a 19.5% rate of return overnight.
It'd be pretty hard to find many investments that can do that, and you have the confidence to actually know that's going to be the case. But when it comes to an immediate tax saving, that's a huge saving.
There's a couple of things to discuss here. So salary sacrifice is the same, gives you the same result as this.
Yes.
So if this person were to salary sacrifice $50,000 throughout the year, it's a little bit less than $1,000 per week. They would achieve the same tax benefits as this person doing it at the end of the year. Where we find salary sacrifice more difficult to do is it's salary sacrifice. It works. It's 6 of one, half a dozen the other. Sometimes it's difficult to get a lump sum in salary sacrifice because you don't have that many pay periods left in that financial year.
Yep.
And here's where we'll cross over to the carry forward concessional contribution legislation, because part of Renee's question and part of episode 313 was talking about carry forward concessional contributions. Is that correct, Ali? I think
I remember.
Yeah.
Yep.
So carry forward, quick brush up on that. Dating back to 2018-19, legislation was enacted to say that if you didn't use your full concessional contribution cap for that particular year, you could carry that forward into future years. So, as long as you meet some qualifications, which we'll talk about in a moment. The big one is that your total superannuation balance, not just that particular fund, but the sum of all your superannuation balances, must be below $500,000 on the previous 30th of June that you're taking advantage of this. So let's assume that's the case. I'll give you an example for a client of mine, a real-life client. Let me follow this thought through. So back in 2018-19, the concessional contributions limit was $25,000. And what that means is that's the sum total of any salary sacrifice, any employer contributions that are made, or any money that you've put in the previous example that we used and reclassified as a concessional contribution for that particular year. So if you didn't use all of that, then you can carry that forward, and you can even use that money now in this current year, 2023-24, because you can go back 5 full financial years.
Yep.
The example that I would use is that if your employer and salary sacrifice contributions totaled $10,000 in 2018-19, then you have $15,000 of available cap space that was previously lost. If you didn't actually maximize that in that particular financial year, you lost that forever. Yeah. Now the rule is that you can carry that forward even into 2023-24 financial year. So a person can actually go back this particular financial year. That cap space has since been increased to $27,500. They could do their full $27,500 in this year, and they could do another $15,000 for 2018-19 in that example if they're concessional contributions. Now, there's people sitting on quite a bit of available cap space. So following that thought through, if your employer contributions totaled $10,000 per year, and your combination of your employer, salary sacrifice, and concessional contributions, totaled $10,000 per year for those last 5 financial years, then you would be carrying forward $15,000 spare from 2018-19, $15,000 spare from 2019-20, $15,000 spare from...
It just keeps on building.
So there's 3 financial years there. So 15, that's $45,000. The cap went up to $27,500 for the 21-22 financial year and the 22-23 financial year. Yep. So you'd be carrying forward $17,500 times 2 years there. That's $35,000. So you would be sitting on $45,000, $35,000. You'd be sitting on $80,000. So in this particular year of 23-24, what that means is that you would be able to use up your existing concessional contributions cap of $27,500. And the maximum you would be able to put in to claim as a tax deduction, as a personal tax deduction, would be another $80,000.
Yeah.
Remaining from those. So here's where that becomes an advantageous thing, is where, for example, a client of mine, and their story is on our website, so they won't mind me saying their names, and their listeners to the podcast. Hello, Adam and Christine. What happened? So Christine, she'll laugh at this as well. She likes to put Adam to work full time. In fact, beyond full time. And she does a great job of looking after the kids and running the house and all that sort of stuff. So Christine had quite a lowish taxable income. Yeah. We hadn't used up her cap space each and every year.
So it would have just kept on building, especially with that low income.
Fast forward, they sold an investment property, and they'd owned it for a long time. There was quite a substantial capital gain. What had happened? What happens with the capital gain is that capital gain is added to your taxable income as if you earn that from wage and salary.
Yeah.
However, you pay the tax at the end of the year. in their situation, over $100,000 of capital gain was added to Christine's taxable income because they sold an investment property in that particular year that they owned for a long time. Christine actually had $68,797 worth of carry forward concessional contributions remaining from previous years. So what we did for her was recommend that she contributes $68,797 to superannuation.
Yep.
And that went in, per the previous example, it started out life as a personal non-concessional contribution. At the end of the financial year, we changed that to via lodging the notice of intent to claim a tax deduction form. We changed that to a concessional contribution. So she had now a personal tax deduction of $68,797. She would have paid significant income tax from the capital gain. However, with that tax deduction, that significantly decreased the amount of tax that she eventually paid. So carry forward concessional contributions, if you have them, look, it comes in handy quite a few times. It specifically comes in really handy if you're selling something for a capital gain. Yeah. In a particular financial year. And property is one of those things because you can't sell half a property and then a half in the next financial year. You can't actually spread those capital gains out. The very nature of property is if you're selling it, you incur sometimes a very, very large capital gain in that particular financial year. So that pushes you actually up through the tax bracket. So with that capital gain tacked on, Christine actually pushed up into the 39% tax bracket. Yeah, she pushed right up high. So with the carry forward concessional contributions dating back to 2018-19, there was the unused amount that we hadn't needed to use because she wasn't on a high income. Yeah. That all totaled $68,797. So we were able to take advantage of that in one particular financial year. Look, it's great legislation, this carry forward concessional contribution legislation. It was brought back in 2019-20. Yep. And this is the first financial year, 23-24, that you're able to go back the full 5 years. Yeah. Because they actually drew a line in the sand. So the legislation actually says you can go back five full financial years, but they drew a line in the sand at 2018-19. So, each year we've added on another financial year. Each year that we've progressed. Like I said, there is. We know that there's caveats to that, Ali. There's your total super balance needs to be under $500,000 on the 30th of June the previous financial year.
That's an important one there, and that's potentially maybe we'll go into a bit more detail about how that works and the risks there in a different episode. But there are things to be aware of, and when using carry forwards as a strategy, remember to always look ahead and make sure that nothing's sort of missed there. But I guess I'm bearing in mind I don't want to give too much information in the one podcast. Otherwise, you have too much, you're not going to be able to soak it in. But what I will explain or go over regarding the concessionals, I'll go over a quick, summary of those main points, and then maybe perhaps you could summarize the carry forwards there. Yep. Essentially, things to be mindful of. So concessional contributions, what they include are things like your employer contributions, salary sacrifice, and of course personal contributions, which you can then claim a tax deduction on. So only obviously once you claim that tax deduction, that's when they become concessionals. Number two is when claiming a tax deduction on a personal contribution, you're essentially changing that amount from non-concessional to concessional. So a good example, if I was to make a $40,000 personal contribution and claim a tax deduction on 30 of it, 30,000 would be concessional and 10,000 would remain non-concessional. And number three is the amount of increased tax return is essentially your income tax savings. So this amount here, so you could be using it you sort of can treat it as a forced saving, and it could be used for discretionary spending, holidays, or again to build your retirement savings even further than you originally had as well. I guess those are the main things. I hope that can sort of help you guys understand what the concessional contributions are and how they can potentially work as well.
Yep, fantastic. That's a great summary, Ali. I just remind everyone that it is so a lump sum contribution is generally made as what they call a personal contribution, and that starts out life as a non-concessional contribution. It will remain a non-concessional contribution unless you lodge a notice of intent to claim a tax deduction. It's not an all or nothing proposition, which is one thing we didn't cover. So the example before, $50,000 is made. It starts out life as a non-concessional contribution. If you only need to use $40,000 of that as a concessional contribution because you've worked it out with your tax planning, then you can lodge a form, the notice of intent to claim a tax deduction form, saying I made 50, I only want to claim 40 as a concessional contribution. So the super fund will deduct 15% tax only on the 40 then, and they'll issue you with a receipt for that $40,000.
Now on that, what if the client or I have claimed a tax deduction on the full 50, but then realised I only need to claim a tax deduction on 40? Can I change that?
You can, and the lovely thing about this as well is that you can actually lodge that notice of intent to claim a tax deduction form. Firstly, you can do that after the financial year is closed off. So if I'm claiming for the 23-24 financial year, I can actually wait until after 30th of June 2024. I can see exactly what super contributions were made by my employer, and then I can actually get it exactly right. I can then go, okay, well, now I can pick an exact figure that I want to lodge as a concessional contribution. Noting that I don't want to go over my cap, my allowable cap. If you do get it wrong, you can lodge a variation. So you can actually say, hey, I claimed $50,000. In fact, I shouldn't have claimed that much. It should have only been $40,000. When you sit down with your accountant, there could be other reasons why that is. You can then lodge what you were referring to before, Ali. I think it's called a notice of intent. A notice to vary a tax deduction, I think it's called, So superannuation funds will have that. As always, look, these are very, 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 very detailed examples that we're using here. It's at the start of the podcast, but I'll remind everyone this is general advice. So we're not looking at anyone's specific situation here. Look, there's a multitude of pros and cons here. One of the negatives of doing this is that you need to be aware that money is then locked up in your superannuation fund until some point in the future to meet a condition of release. Look, it's not for everyone. Certainly seek advice if you want to talk about how this could work for you.
Correct. Excellent. Well, as I mentioned earlier in the podcast, what I might do to, I guess, potentially help you understand a bit further is I'll include a link in the description to just provide a short video going over the strategy, how it works, and then at least that way you've got a visual to help understand it a bit better. No worries. Thanks for listening.
Thank you for listening to the Money Over 50 podcast with Money Over 50 Financial Advisors. For more information and resources, visit the Money Over 50 website, mo50.com.au. We look forward to catching up again soon.